If you're self-employed and getting a mortgage seems harder than it should, then this episode is for you. Welcome back to the Rock and Realty Podcast. Today, I'm giving you a backstage pass to the world of self-employed mortgages and answering some big questions like, how do you know your business is mortgage ready? And if it's not, what's the game plan? Today, I'm chatting with Ahmad El-Farram, a mortgage agent with Capital 360 Complete Mortgage Solutions, specializing in self-employed borrowers. That includes sole proprietors and incorporated owners. So this is going to be a good one. And please don't forget to hit the subscribe button so you never miss an episode. I've got some really good ones lined up. Let's get into it. So tell me, what is the fastest lever or the best lever to pull when looking at qualifying someone for a mortgage? Is it their credit? Is it a down payment amount? Is it debt? Or is it income presentation or something else?
That's a great question. And the short answer is they're all equally important. And what we do is once we have an idea of the big picture where I've gotten the application, I've collected all the documents that I need, and I can see everything in front of me, it's almost like a scale and we have to hit a certain number. And sometimes the lever is different. Sometimes credit is an issue. So we have to take credit off the table, and then we put in a strategy that says, okay, well, we're not going to rely on, the partner's income because their credit is terrible, but we're going to bring in a cosigner that's a parent until the credit gets up. And then we put them on a credit plan. Now, if we're not in the actual purchasing process and we have time, then that individual is on a credit specific plan. And I've helped, I have like one story that I'll share real quick that was like, it's for me, it's like a hero story for me. Like, I just love it. I had two young buyers, and one of the buyers had a credit score of 450. Knew nothing about credit cards, how to manage them, how to do anything. Came from a background where they never owned anything either. So it was never taught. And as you know, it's not really taught in school. So what ended up happening was I worked with her, and it was a referral from a good realtor. And I said, you know what? I'm invested. It's a referral. I really want to help these people. I want to help to build that relationship. Within 8 months, she purchased and never imagined. And actually, the words out of their parents' mouth is, I don't even know why you're bothering because you're never going to be able to purchase. We fixed her credit with a new cell phone plan and a $400 a month prepaid credit card. And in 8 months' time, her credit score was above 750, and they purchased their first home, and they're living in Bradford right now. Listen, the thing with credit is nobody understands how credit is calculated. And if you understand, it's like, for me, it's like a game now. It's like, okay, what's your credit score? It's like, all right. Well, first of all, I just want to say anything from 680 and up to 900 is all the same. So if anybody brags about a 900, you're sitting at, a 685, it doesn't matter. They're not getting a better deal than you. So let's get that off the table, right?
Wow.
But,
You
understanding
heard that? No,
how,
I'm kidding.
right?
I love it.
Understanding how it's calculated, you can manipulate it to your advantage, right? With a prepaid credit card and one Rogers cell phone plan, because Rogers reports payments to Equifax and TransUnion. And so does one particular, a side note, it's a Capital One prepaid card. And they can't say no to you because it's prepaid, but it's the only prepaid card that actually registers the usage and the payments to Equifax and TransUnion.
If no one's learned anything else out of this podcast,
take that.
That is the one you want to take with you. Wow.
Forget everything else I said. Forget everything else.
No, I'm kidding. But wow, what a gem of a point of information that I can bet you $1 million people are listening to that going, oh my God, this can change my life right now. It's like really something that can change people's lives, because like the parents of that child that you just spoke about were like, yeah, you're never going to get a house. 8 months later, she's got a house. Like, wow, that's incredible. Like I'm shocked right now. That's really amazing.
So we look at different situations. Everyone's got a different situation, whether it's credit, whether it's down payment, whether it's, household income. And we're looking at all these levers and we're saying, I'll reveal the curtain again. I'm the kind of person that's always saying, what is the path of least resistance here? What is going to get us to where we want to go? the fastest way possible with the least amount of effort without compromising anything. So it's not a compromise of quality or anything like that, but it's like, let's be real. Like, how do we get from A to B as quickly as possible without wasting any energy or time? And,
Right.
so we look at all those things and just basically based on their needs, we determine, okay, what's the best way moving forward? And then I present it. Like, it's for me, when I learned that I don't need to convince anybody of everything, I just need to give them the options. The numbers don't lie. You pick, and
That's
that's
it.
it.
That's it.
And either way,
So
whether
true.
we end up working together or not, I know that I've left them in a better position than they were than they started. And that's all I can do.
Yeah. It's a secret to true partnership as an entrepreneur. We can say we're selling, 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 but selling today is really about exactly what you just said. Here are the three options. Here's what I recommend. But at the end of the day, you're going to do the whatever's best for you, which is great. So there's a sole proprietor or an incorporated owner out in the audience right now thinking, what are the forms that I need or what documents do I have to have ready to send to you after we've had our discovery call and you're like, these are the ones I need to send over to get you qualified. What are the top or what are the documents that they need to have ready? And are they different from each group, sole proprietor to incorporated?
Yeah, they are different. So regardless if we're using them or not, and we're going to start with the incorporated individuals, I am going to collect a 2-year history on all the CRA documents. Like T1 generals. We're gonna get all of that just so I have a clear picture of it. Now, the other thing that I'm going to get as well is the NOA. So I want to know, and for a lot of cases, I'm not even showing the T1s to the bank, right? Like a lot of the times they don't even want to see it. So we're not showing it to them. But what I want to see is I want to see what's actually being reported. I want a full picture. And then I can determine what's the strategy here? What's the pathway we're going to take based on seeing everything so there are no surprises. And then we disclose only what we need to disclose in order to satisfy the bank. So I'm also looking at the NOA. So the notice of assessment is the document that you get back after you pay
Hmm.
your personal taxes. And like we said, the only one that can get between the house and the bank is the government. So you got to have that. You cannot be owing them any money or have a plan to pay it off before we actually close the mortgage. So that's what I'm looking for. But the main thing I'm looking for is we're looking for a business license to make sure that it is at least 12 months active, and it is still active. And we're also looking for a 12-month bank statement period that shows the financial health of the business. So in a 12-month period, so if we were to start in January, I'm going to go from January all the way to December. So I'll even take 13 months. I want to see every transaction, full PDF statements that they get, and I'm going to look through it with their help to understand the story because I want to know where's the money coming from. I want to know where's it going. And a lot of times expenses or money transfers out of the account, they just have a number associated with it. So it doesn't tell me what it is. I'm looking to see what's reoccurring because the reoccurring expenses will become the debts that I have to subtract from the gross income, all the money that comes out. Only the reoccurring. And I really stress that. So it's very important that we have a clear picture of what is reoccurring. Now, the other thing that I'm going to ask them for is invoices or contracts that they've sent to clients. So are there any? I'm usually looking for about the bank asks for 6. I'm asking for 10. So give me 10 of the past invoices from the past 12 months so that we can see the payments going in. So the actual invoice will coincide on the bank statements of funds coming in. Now, sometimes it's not the exact number because if we take a contractor, for example, they're leaving a deposit and then there's a second payment, maybe there's a third payment, and then there's a final payment. So it's going to be broken up. Now, here's the beauty of the contractor. If I get, you know, if he has a contract in place for, $100,000, he doesn't have all the $100,000, but I can show, let's say, $40,000 or $50,000 of deposits and that the outstanding balance with dates as to when he can expect those. That tells a good story, right? That tells a great story that there's future funds coming in.
That's right.
So those are really the things that we're looking for.
And what about for the sole proprietor?
Great question. So sole proprietor, again, we are, if we were to take, let's say, the avatar of the real estate agent, what we're looking at is we're looking at their commission statements. over the course of 12 months. We're going to get a year-to-date statement showing what they've made so far. We're going to also do 12 months of bank statements that show those deposits going into their bank account. Now, fingers crossed, we're talking about green flags. It's a totally separate account from their personal account, even though, it can be a business account, it can be a separate checking account. But as long as I'm not seeing, trips to the liquor store and trips to, the weed shop, I don't want to see all that stuff. I don't want to see all that stuff. So, and listen, it's all legal, but it just
It's
doesn't
all
look good
legal.
when it comes time. It's all legal. It's all legal,
It's
right?
such a
So,
good learning, though. It's such a good learning to keep things separate, no matter if you're a sole proprietor, especially if you're incorporated. Separate expense from your business account, expense for personal from your personal account, not from your business account. Never merge the two or marry the two. It's two very separate. Such a good learning for the audience, for sure.
and I'm going to say this, definitely consult with your accountant, whoever you're using.
Yes,
Just because an expense comes out of a different account does not necessarily mean it cannot be used to lower your taxable income on your personal side. And this is
that's
why a lot
true.
of people use, here's my recommendation. And again, take it for what it's worth. I'm not an accountant, but I'm going to say this. That's why people have a credit card. They put all their expenses on the credit card. The credit card statement has all the mess, but their business bank account pays the credit card once a month and you don't see all the mess. So that's one of the strategies that we implement when I see somebody that has everything jumbled together. It's like, okay, good start. You're making good money, but you got all your kids' daycare expenses and things that has nothing to do with business, right? So
Yeah.
it's like, okay, so let's get you a credit card. Get the credit card.
Yes.
Today is day, and they're like, well, how long is it going to take? 12 months from the date that you implement it. Really? Yeah. Well, guess what? Today's day one, and in 12 months from now, you would have wished you started today. So
So
let's
true.
start today.
So true. So if you're looking to make your next move, whether it's to Orangeville, Dufferin County, or the surrounding area, people just like you reach out to me every single week to help them with their next move. And I would love to have a private conversation with you to see how I can help you make the right decisions, avoid costly mistakes, and properly guide you through the process. Click on the link in the description below to set up a time. Now let's get into this episode. So we've all heard about alternative lenders. And so when it comes to the self-employed, how do you decide, like, what's the rationale behind utilizing an A lender versus an alternative lender?
That's a great question. And I think I wanted to start just by saying that there's a lot of unnecessary stigma in regards to alternative lending, right? And, what I would say is the majority of people simply, because of the cost and the value of homes, and now that mortgages, the actual mortgage balances are significantly higher because the purchase price of the homes have gone up post COVID. Most people that were always, let's say, traditional AAA clients that walk into the bank simply have, because of the environment, been shifted to the alternative side. And there's nothing wrong with that, because at the end of the day, it's a mortgage product that gets the job done, gets people into homes, whether they're self-employed or not. Now, in regards to self-employed individuals, majority of them, they qualify on the alternative side. And that's just the way that we do it, because at the end of the day, if they are self-employed and implementing any kind of tax strategy, then they are qualifying on the alternative side, because their personal income is too low for them to actually walk into a bank and qualify the traditional route. And there's nothing wrong with that.
How would you describe or define, or if you have any examples of what an alternative lender is for those in the audience that maybe don't know that that's an option?
Yeah, for sure. And I think just to clarify, it's not necessarily an alternative lender, but it's an alternative mortgage product, right?
Mm,
So, we're not talking about, if we're talking about which institution we're going to, a lot of the traditional institutions and like credit unions, they offer alternative products. And those products allow for individuals that are self-employed or people that have, other challenges, right? That aren't
right.
necessarily the result of a tax strategy for their business, but they need to stretch beyond the traditional rules of
Right.
qualifying. And those traditional rules would be your income versus the amount of debt that you can carry. And simply by having at least a 20% down payment, majority of lenders offer those alternative products that stretch the boundaries of those rules. And they allow you to purchase if you are faced with one challenge or another.
So what I heard, and correct me if I'm wrong, is there if it's wrong or if there's other factors to consider, is if a sole proprietor or someone who's incorporated is not showing that they're making a lot on the books, let's say, that's when you have to consider alternative lending. Are there any other situations?
Yeah, for sure. There's all kinds of different situations. Another one would be simply because, you know, a life incident happened around the time when a mortgage is up for renewal and the individual can't simply sign off and renew. So let's say someone got ill and they were unable to work for 6 months. Being absent for 6 months from a full-time job, even though you may go on unemployment or whatever the situation is, it affects your year-to-date income. And if you are simply getting a renewal and you're signing that renewal because you're not making any changes to your mortgage whatsoever, then it's not an issue. As long as you're paying your mortgage on time, you're almost guaranteed you're going to get a renewal letter. But let's take the example where somebody fell ill, had medical expenses, and had to pay for those medical expenses on credit cards, which happens quite often. And what ends up happening is, well, yeah, they get a renewal in the mail and the renewal looks good. But the only challenge is that renewal doesn't consolidate any of that extra debt that they're now carrying on credit cards at 29, 35% interest rate. So they would be a candidate for somebody that would potentially need to refinance, not just the straight renewal, but refinance and include all that debt to get it off of their shoulders so that their monthly cash flow could go back to the way that it was before. So in that situation, a refinance basically needs to look at their past 2-year history. And because they were absent, their 2-year history isn't consistent, right? There could be some dips in it. So what ends up happening is we shift to, sometimes it's even with the same lender, but you could shift products that allow for that refinance that will overlook the fluctuation in income and then basically allow them to do that refinance. Whereas it wouldn't have worked if they didn't have the ability with an alternative product, if that makes sense.
It does. It makes a lot of sense. I have a follow-up question to that. Have you ever worked with a client, or has there been a situation where there is a product that will work, but you actually kind of veered them towards a different product? Does that ever happen?
Well, okay. So in today's environment right now, bank retention is extremely high. So generally speaking, when I get someone that comes to me for a renewal, before I even entertain and invest the time into having the conversation, I ask them a few questions. And the number one question that I want to know is, have you gotten a renewal letter back from your bank? Right? Because
Mhm.
I want to
Mhm.
know what we're working with. I want to know what we're up against because, going through the mortgage process again as a refinance can be challenging for a lot of people. I mean, like I said before, it's like a financial physical. And if you don't have to do it, then there's no need to go through it rather than, so I'm looking at what's being offered. Is the offer that they're being presented from their bank actually solving their problem, or is it just renewing a mortgage? And it comes down to basically the root need that they're reaching out to me, and what is that?
Mm.
What's the pain point? Is it cash flow? Is it, has something changed? Have their goals changed for the next 5 years, and maybe the mortgage isn't in line with that? So there are always times where multiple products work, and at that point what I do is look at the path of least resistance, because I'm thinking about the client journey, right? So as much as I want the business when somebody comes to me, if it's apples to apples and they can get the solution from their bank, it's in their best interest. And in regards to saving myself the time, because I'll lose it anyways at the drop of a hat in the 11th hour, where the bank will come in with another offer and counter and take them back after so much time's been invested. I'm
Right.
directing them back to the bank, and I'll help them leverage the bank to get a better rate, especially if it's something that I can't touch or something that's exactly on par with what I'm offering.
Have you ever had a client go from an alternative product back to an A lender? Like, what creates that kind of circumstance?
It's a great question, and it happens all the time. And in fact, some of our lenders actually have what they call a graduation program. So you get the mortgage, you get the property using an alternative product, and then when
Mm,
that mortgage comes up for renewal, depending on where the ratios land, and in most cases, we can transition them right over to the A side, and it doesn't cost them anything because they're staying with the same lender. So there's no additional fees, no lawyer fees, no discharge fees, nothing like that. So I'm really keeping that in mind. So a lot of the options that I put on the table will include that as part of the selling feature. That, okay, look, this is a 3-year plan or a 5-year plan. And at which point, when it comes near completion, we're going to
mhm.
transition you using the transitional program with the actual lender that they're with, which is fantastic because at that point, they end up saving a little bit more money. And it's just, again, it's the path of least resistance and the ease of the client journey.
That's great. I always wondered about that because, and correct me if I'm wrong, but alternative lenders, if you have to, or products, if you have to go that route, sometimes, most of the time, they're higher interest rates. So to be able to come back to an A lender, may have a better interest rate is really the journey that you want to be on. Is that, am I on the right track when I say that?
Yeah, for sure, for sure. So I would say average would be a 0.5% more.
Okay.
So there's a couple things. So generally speaking, if we're going the alternative route, there's usually a 1% lender fee, and the interest rate on the mortgage is usually
Mhm.
0.5% higher. Now, again, we put that into perspective. If someone has a tax strategy in place, 0.5% fee is pennies in comparison to what it would be to boost your personal income in order to qualify, right? We're talking about putting
Mhm.
yourself into a much higher tax bracket. And at the end of the year, you're paying thousands and thousands of dollars more, as opposed to, let's say, an extra $7,500 a month on the mortgage payment, right? Rather than, upping what you owe the CRA at the end of the year, $40,000, $50,000, depending on how much you're showing.
Is there anything that you wanna share that could be different between someone who is a sole proprietor to someone who is incorporated when it comes to alternative products?
Uh, no, the products are pretty much the same. But what I will say is, generally speaking, and I did a presentation today to a group of realtors breaking down how to identify, and I think for working with referral partners, the one thing that I try to do is, come to the table and give them the tools to start identifying opportunities that they might not have seen before. And one of those
Mm.
opportunities is identifying that self-employed buyer, because a lot of realtors that I know, they stray away from it because they don't really understand it. They've never had luck with it. So really what we're doing is, in regards to products, they're pretty much the same, but I will say it is significantly easier with somebody that's incorporated, because it's very rare that we see a sole proprietor that is operating their business with a separate checking account.
Right.
It's just a habit that we see, that one of the patterns that I see is usually sole proprietors have everything all mixed up and jumbled together.
Mm.
And it, again, like I said, when your bank statements and look like a mess because there's no separation, all it says is that you're a risk.
So you've had your discovery call. You've talked to someone who needs to be on a plan, which means they're not ready now. And so, what would you say are the top 3 actions that this person must take to make the biggest difference in the next 6 to 18 months?
Yeah, so that's a great question. I'd say the biggest step that they could take that's going to have the most impact is, number one, if they don't have a separate checking account, get a separate checking account strictly for the business. That'll be day one. The next
Mm.
thing you're going to want to do is, you're going to want to understand and control the way that money flows in and out of the bank account. And what I would say is, get a credit card that's dedicated just for the business. If you're a sole proprietor and it's not a business credit card, that's totally fine, as long as it's a completely separate card that you only use for your business transactions. And basically the flow of money would go like this. Commission statements or invoices comes into your bank account. From the bank account, you basically let it sit there in the checking account. Any regular day-to-day expenses would get paid on the credit card. And at the end of every month, you pay the credit card, and then you pay yourself via e-transfer. And this is the pattern that we want to create, because what we're doing is we're keeping that actual bank account, the bank statements, very clean. And we're not seeing a lot of jumbled up expenses that aren't necessary to actually run your business, but having all of those expenses come off of one credit card that's dedicated to your business. Again, like you said, your accountant is going to thank you, because those are all the business expenses that can be used for write-offs. And then, basically just keep it as clean as possible.
That's amazing. Is there any different advice that you would give someone who's incorporated to someone who is a sole proprietor on this type of plan?
No, exactly the same. Exactly the same. I mean, it's not
Awesome.
it is often that we still see, corporate bank accounts a little bit messy, things coming out of there, like payments that aren't necessarily business related, like home insurance, things like that, utilities, if they're not business related. I get why they're there. It's a convenience knowing that, especially if you're running a business and it's the bread and butter that pays everything. It's just easier to have it come out of there. But taking the extra step to organize things in a way that looks good is going to be worthwhile, especially if you want to leverage your business, whether it's for a mortgage or whether it's for a line of credit or whatever it is. You're doing it, you're setting things up in a way that makes sense and tells an appropriate story.
That's great advice. Do you have an example of a client you put on an 18-month plan? What did they do to turn things around and actually achieve, getting that mortgage at the end of that 18 months?
Yeah, I mean, it happens all the time. I would say it's usually about a 12-month process, not even 18 months. Really, what it is them just taking that first step and getting organized. And like I had said, so they ticked all the boxes on that discovery call. That they are keeping business expenses separate, but we still see a lot of additional expenses that aren't necessarily business related, like high ticket items like vehicles, right? So vehicle payments that aren't necessarily required to run the business. To be honest, the vehicle isn't even under the business's name, right? So it's, but it's being paid from that corporate bank account. Getting that out of the bank statements, and paying that from a personal account, meaning, let's say there's a $700 or $800 a month lease payment on a car, and the car is under the personal name, not under the business name. We get that payment off of that corporate bank account, and then they just up their monthly allowance that they're paying themselves to their personal via e-transfer or however they decide to pay themselves. And then they pay that $800 a month car payment directly from their personal account. And what happens is if we get that off the books for 12 months, we're taking an $800 a month debt that doesn't need to be withdrawn when calculating their net income from their gross. And that makes a huge difference, because now, again, anything that gets pulled out of the business as a payment, as a draw to the business owner themselves, isn't considered a debt. It does not have to be deducted from the gross to get the net. An $800 a month car payment that has nothing to do with the actual business. That doesn't mean you still can't use it in regards to your taxes, and talk to your accountant about that. But, it just doesn't have to come from the actual corporate account.
Excellent. Is there any hard stops? Don't do this during this time frame, like this 12 months, like anything that a sole proprietor or an incorporated owner should never do to ensure that they stay on track?
Well, usually what it is, it's the things that there's a good chance they're already doing things that they shouldn't be doing. And the whole idea is that we use this as day one to start a new process. And there's a huge percentage that just don't make that change. Change is hard, man. Like, it really is. Like, I get it. We're creatures of habit. We do what we do without even thinking half the time. I mean, even look, I'm even guilty of it too. Like, sometimes I want to, pay cash for things, but it's like, you know what? I got QuickBooks on my phone. I want to scan the receipt. My accountant wants to see everything coming and going. He doesn't want me buying things with cash, because it's more work and it just doesn't look as good. So, there's a learning curve, and it's tricky because, not having the banking set up on day one means that day one can keep getting pushed out if things aren't done in a timely manner.
That's great. Such great information. Now I'm excited to get into some rapid fire questions. These are going to be true and false. I know it's one of my favorite things to do on this podcast. But I'm going to share some statements with you. And you're going to tell us True or false? And why? Why is it true or why is it false? Okay, ready?
All right, let's do it.
If you're self-employed, you automatically need 20% down.
Yes, but there is one other
True and
product
false.
that, yeah, it's true and false. I'm going to say
Nice.
yes, you should plan to have 20% down because the product that, there's one lender with one product that you qualify with 10%. I've never seen anybody tick all the boxes and actually make that happen. So plan to have 20%.
Excellent. Second question, and I think we answered this earlier on, but you must have 2 full years of self-employment before any lender will consider giving you a mortgage.
That is true. Now, just to clarify, the business license only has to be active for 12 months, but you need to have at least 2 years experience in that field.
That's a great answer. I know you've said that before, but it's always good to hear that again. If your business revenue is high, but your taxable income looks low, the bank can figure that out.
They can't.
Find out.
They can't. Well, first of all, it's not that. Okay, so I'm going to say that's false because by structuring your bank account in a clean manner shows them that you have clearly implemented a strategy that is doing that. But when everything is jumbled up together, they can't figure out what's an expense and what isn't. So everything looks unclear.
Right. Yeah, it's a great answer because and I mean, I've had this thought before is like, I'm going to give them the paperwork, but they're probably going to do some due diligence behind the scenes and look at all my stuff. That doesn't happen. It's whatever they ask for is what they're looking at and considering. Is that correct?
Well, here's what's going to happen. Full disclosure, pull the curtain back. What
Let's do
happens
it.
is the bank is going to take your bank statements and they're going to feed it through an algorithm machine. All it's going to see is debits and credits. And the reality is if it's not clean, that's not going to really reflect what your true business potential is. We want it to be a clear painted picture with a roadmap showing that you have, these are your debits, these are your credits, and this is the strategy that I've implemented in order to tax shelter my income. And
Perfect.
they're fine with that. It just needs to be clear.
Good. That's great. Great answer. Like I'm learning so much, just so you know. This is really great.
That's awesome.
Last question, being incorporated makes it easier to qualify.
I would say it does, definitely, because when you're sole proprietorship, what ends up happening is, from what I've seen time and time again, you're still taking advantage of all the write-offs, but you're not sheltering any money. All you're doing is just taking the write-off so that you don't pay anything at the end of the year. It lowers your taxable income. And what ends up happening is it's not like you can say, yeah, I've lowered my personal income tax, but my corporate, there's no corporate. So if you lowered it, you lowered it. And then all you're coming to the table with as a sole proprietor is what you're left with at the end of the year that you claim to the government. That's the difference.
That's great. Well, I've learned so much. This has been like a really great session. I always like to end my podcast sessions, with some music questions. I'm a music lover, as you know. I know we talked a little bit about it before we started this session, but I got a few questions for you if you're up for it.
Let's do it.
All right. What's the first song that you remember being obsessed with? And what was it about that song that you just love so much?
All right. So no judgment here. I think one of the first songs that I remember being obsessed with was Beastie Boys' "Hey Ladies." So I think that would have been like 1990.
Hey, ladies!
Yeah. And in my defense, it was definitely the video, because if you see the video, it's all like 70s inspired. And if you learn the story, they rented out this house in like California that was owned by some theater production owner. And there was all these costumes, and they just shot a video just while they were there recording the album.
My favorite one was Thriller. I was obsessed. I was obsessed with Michael Jackson when I was young, obsessed with Thriller, loved the video. I had friends that were terrified of it, and I just loved it.
Amazing.
Thriller was mine for sure.
I got a question for you. Do you remember your first concert?
My.
Like the one that really stood out.
This is really embarrassing. I don't know that I'd put this on the podcast, so maybe I will, just to have a little fun. New Kids on the Block.
I wasn't cool enough to go to that. My parents did everything. That was probably in Hamilton, wasn't it?
No, it was in Toronto. I was obsessed with boy bands. in my mid-teens, early teens. And then at 17, I found Def Leppard, Bon Jovi, Metallica, and the rest is history. And now it's all about rock and roll.
That's awesome.
How about you? What was your first concert?
Well, I was lucky enough to be the youngest of 3 siblings. My oldest brother's 6 years older. My sister is 3 years older than me. So musically influenced by, the older generation, which is to my benefit. I remember the first concert was 1993. It was Tool at Varsity Arena.
Okay,
So
that's
that was
way cooler.
that was a big one. That was a good year. 93, 94 was like Tool, was Lollapalooza,
Oh,
which was huge.
wow.
So yeah, there
Yeah.
was pretty much shaped everything. Just, I have my brother and sister to thank for that.
I was the middle child, so I feel like I was the rebel of the group, and I just did things differently, dragged my sister along with me who was younger than me. Yeah, really interesting. Very cool. And would you say that that was the best live show that you ever saw, or was there something else that you absolutely fell in love with?
Man, there's too many. There's honestly so that's like our thing. So my brother, my sister, and I, families, relationships have ups and downs, but we would always go to concerts together, and it would just be like the nice reset for us, right? But man, there's too many. Most recently, the Hives. If you listen to punk music, the Hives are an older band,
Yes.
but they came
Yep.
back to town and they played what was it? The
Combo. Wow, it's classic.
whatever. But man, there was like 200 people there, and it was unbelievable. We ended up hanging out with them afterwards, and
That's so
it was
cool.
pretty wild. Everything from the small shows, I really like the small shows. I'm not really a fan of the big. We took my son to see Metallica most recently, and that was amazing because they're amazing.
They are amazing.
Any opportunity to see in a small, 200 people was like unbelievable.
That's fantastic. Now, have you ever ventured into, becoming a rock star or playing an instrument? Like, have you ever been in a band?
Yeah. So, yeah, funny enough, I did have a punk band when I was growing up. And my parents, kudos to them. They understood that if you want to keep an eye on your kids, you want to have the coolest house on the street. So our house was the only house of all of our friends that would allow a drum set. So, wherever the drums
Wow.
are, the rest of the band follows. So that was pretty much, and I
That's
never bought them.
true.
It's like people would just, my buddy just bought his drums and just delivered them to the house. We set it up in the basement, and next thing you know, we've got PV amps and stacks and crates, and parents, they didn't care. They just let
That's
us jam out.
awesome. Sounds like my basement right now, but it's for me.
You don't need anybody's
Like,
permission. You don't need anyone's
no
permission
permission
now.
needed. No permission needed. Before we end off today, one last question for you. Is there anything else that you feel maybe we haven't covered that you think is really important to share with this audience? Perhaps it's a new sole proprietor, new incorporated owner. Any last words, any final words that you think is really important?
Yeah, I think, you know what, if you don't take anything away from this other than the fact that both of us have awesome taste in music, I think what you want to do is, if home ownership is on your radar and you've never owned before and you're self-employed, or if you currently own a home but you are now self-employed and you weren't when you first got that mortgage, you want to get the conversation started early. I would say at least 12 months in advance. Like, all the things we've talked about, the window of business transactions that we need to show is a 12-month window. So the last thing you want to do is wait 12 months thinking that what you've done is correct, only to find out that it's going to take another 12 months. So whether it's with me or whether it's anybody else, another mortgage agent or broker, somebody that you trust that knows self-employed mortgages and how to qualify for them, get the conversation started so that they can give you that roadmap and give you a target that you need to hit. And if you have a 12-month target to hit, you will hit it as long as you take the steps. And most people are a lot closer to their home ownership goals than they actually think. And all it takes is a few little tweaks. But the big thing that you cannot rush is time. So have the conversation well ahead of time so that time is on your side, and then you can do those adjustments and know that when day one starts for you, it's truly day one in regards to how things need to be organized.
Perfect. Now, if someone wants to work with you, how do they get a hold of you? What's the best way?
Yeah, I mean, I'm on Instagram. You can give me a call. I do pick up my phone every time it rings, probably after the first ring as well. But, take a look. You can connect with me online on Instagram as well through the brokerage. I've got my email and my phone number. So I'm always happy to answer questions, and jump on a discovery call. I love learning about, new businesses and how people are making money.
I'll make sure that I have all of Ahmed's information in the description below, including his telephone number, email, and fun Instagram. I said that in the beginning. Really, really cool, insightful Instagram. And I want to thank you again for joining me today. It's been so informative and fun. I can tell you're like a rock and roll spirit deep down inside. So happy to have you. Thanks again.
Thank you so much. I appreciate the opportunity, and I can't wait to see this.
Thanks so much for tuning into this episode. Have any questions or want to recommend a future guest for a show? Leave a comment or send me a DM. And if you're ready to take the next step in your real estate journey, schedule a call using the link in the description. Make sure to follow my channel so you never miss an episode. And if you found this helpful, leave a comment. It helps others find us. Thanks so much. That's a wrap. See you next time.